Why can banks create money from nothing? The answer is deposit creation through lending. The moment banks issue a loan, they create new deposits. Traditional textbooks explain that $100 in deposits becomes $1,000. But the reality is more complex. Why is this possible? This slide explains everything. The classical money multiplier model. With a 10% reserve requirement, deposits in the banking system can expand up to tenfold. But this is a simplified model. Real banks don't lend from existing deposits. The moment they issue a loan, they create deposits by crediting the borrower's account, and they secure the required reserves afterward. What's more, reserve requirements aren't the only constraint on lending. Capital adequacy regulations set minimum capital levels against risk-weighted assets. The liquidity coverage ratio requires banks to hold liquid assets to withstand short-term funding stress. This is the reality revealed by a century of financial system research and regulatory reforms since 2008. This isn't speculation. This is the understanding established by central banks and academic research. And this is comprehensible. Look at the theoretical models. Follow the real-world constraints. Now you can understand the essence of the modern monetary system. Today I'll show you how this mechanism works. Here's a crucial fact. Banks don't lend from deposits. The Bank of England made this clear in 2014. The explanation that deposits come first, then loans, is inaccurate. The reality is the opposite. Loans come first, deposits are created simultaneously. Banks assess the borrower's creditworthiness. If approved, a keystroke increases the borrower's account balance. At this moment, new deposits are born. On the bank's balance sheet, loan assets and deposit liabilities are recorded simultaneously. Then they secure the required reserves, either by borrowing in the interbank market or receiving supply from the central bank. This is the reality of modern money creation. Classical textbooks present the money multiplier formula, 1 divided by the reserve requirement. If the reserve requirement is 10% or 0.1, then 1 divided by 0.1 equals 10. A theoretical upper limit. But this explanation rests on a critical assumption, that reserve requirements actually exist and function. Reality differs. The U.S. Federal Reserve changed the reserve requirement to 0% in March 2020. A permanent measure. So what constrains lending? Capital regulations. Basel III sets a minimum common equity Tier 1 capital ratio of 4.5% against risk-weighted assets. To lend $1,000, a bank needs at least $45 in capital. And the liquidity coverage ratio. Banks are required to maintain liquid assets at 100% or more under a 30-day stress scenario. These are the primary constraints on modern lending. So how do central banks control the economy? The primary tool today is policy interest rate manipulation. In the U.S., the federal funds rate. In Europe, the main refinancing rate. In Japan, interest on policy rate balances. By moving these short-term rates, they influence financial conditions across the economy and open market operations. Central banks buy and sell assets like government bonds. Buying injects liquidity into the market. Selling absorbs liquidity. This affects interest rates and asset prices. What about changing reserve requirements? Some emerging economies use this tool, but it's not the primary instrument in advanced economies. The U.S. has fixed it at 0%. The ECB's minimum reserve system is largely ceremonial. The reality of monetary policy is interest rate manipulation, not reserve requirements. In 2008, this system collapsed. The moment Lehman Brothers failed, trust between banks evaporated. Banks refused to lend to each other. The TED spread, an indicator of credit risk. This is the difference between interbank lending rates and treasury yields. Normally below 0.5%. In October 2008, it exploded to 4.6%. Roughly tenfold. Capital regulations didn't matter. Liquidity regulations didn't matter. Banks simply stopped trusting. The mechanism of credit creation completely froze. Companies couldn't secure working capital, and bankruptcies cascaded. Mortgage lending froze, and real estate markets collapsed. Stock prices plummeted, pension funds suffered massive losses. The entire economy froze. Note that LIBOR, the benchmark at the time, was abolished in June 2023 following manipulation scandals. The system has now transitioned to more transparent benchmarks like SOFR. But the lesson remains unchanged. The monetary system depends on trust. Here's another critical fact. Most of the money you use doesn't physically exist. It's numbers in a bank's computer. In the U.S., M2 money supply stands at roughly $20.8 trillion, while currency in circulation is around $2.3 trillion. About 11%. In the UK, cash represents only about 3% of total money. Ratios vary across economies, but the vast majority is digital data. The balance displayed in your bank account. It's a number recorded in the bank's database. Only when you withdraw cash from an ATM does that number convert into physical currency. And money isn't convertible to gold. The gold standard ended. So what supports the value of money? Legal frameworks and confidence. Trust in central banks and governments. And government taxing power. These are the foundations of the modern monetary system. So do deposits really exist? The answer is yes. Legally, deposits are bank liabilities, contractual claims. But banks don't hold the full amount of deposits in cash. If everyone tried to withdraw deposits simultaneously, a liquidity crisis could occur. This is a bank run. So how do we prevent this? Deposit insurance. In the U.S., the FDIC protects up to $250,000 per account. Depositors can rest assured. And the central bank's lender of last resort function. When banks face liquidity crises, the central bank provides emergency lending. This prevents systemic collapse. Furthermore, Basel III's liquidity coverage ratio. Banks are required to hold sufficient liquid assets to survive a 30-day stress scenario. These institutions underpin the modern banking system. Now let's organize today's analysis. Here's the summary. First, the reality of deposit creation. Banks create deposits by crediting borrowers' accounts the moment they issue loans. They don't lend from existing deposits. Loans come first, and they secure required reserves afterward. The classical money multiplier model is a textbook oversimplification. The reality is endogenous money supply. Second, modern constraints. The U.S. Federal Reserve changed the reserve requirement to 0% in 2020 and made it permanent. So what constrains lending? Basel III capital regulations. A common equity Tier 1 ratio of 4.5% or higher is mandatory. And the liquidity coverage ratio. 30-day stress resilience is required. The primary tool of central banks is policy rate manipulation, not reserve requirement changes. Third, systemic fragility. In the 2008 financial crisis, trust between banks collapsed. The TED spread expanded roughly tenfold, from 0.5% to 4.6%. Credit creation stopped, and the economy froze. To prevent this, we have deposit insurance and the central bank's lender of last resort function. And most money is digital records. Its value is based on confidence. Your bank account balance legally exists, but its value rests on an invisible foundation called trust. Let me know your thoughts in the comments. Thanks for watching. Understanding the modern monetary system is understanding the essence of economics. This channel analyzes world events through geopolitical and economic lenses. Facts over emotions, mechanisms over opinions, deepening your understanding of the world. Subscribe, and let's explore the truth of economics together next time. See you in the next one.